So, brought you the details. I mean, there's a lot to get through there. Let's bring in Josh Mahony, who is the Chief Market Analyst at Scope Markets. Great to have you back, Josh. So, we heard the negativity coming from the IMF. It's saying potential global recession, linking it to the Iran conflict. If you're working at a central bank now, what kind of policy shift would you be looking for to avoid an inflationary spiral but not stifle growth?
Yeah, I mean, it kind of runs tantamount to or in reverse of what we're actually seeing in terms of the financial markets at the moment, which many of them have recovered the vast majority of the sell-off that we've actually seen over the course of this crisis since the beginning of March. So recession fears certainly on the tip of the tongue at the IMF, and certainly for the central banks, they're going to have to weigh up whether they need to do something or not, quite frankly. Look, it really depends on whether they're able to look through any shock in terms of inflation and instead focus on the growth side of things, or whether they're going to say, okay, fine, core inflation remains under control, but headline inflation is running away, and therefore we're going to have to tighten rates. So really it's going to come down to each central bank. And certainly when you look at the market projections in terms of which central banks are expected to raise rates rather than just simply sit on their hands, the Bank of England, that many predict will do so. And when you look at the country that the IMF are calling to have the worst impact from this in the developed world, it's the UK.
We've seen Asia-Pacific shares rally 1.5%. Great, but I mean, we've seen oil prices and market shares yo-yoing, almost dependent on what comes out of Donald Trump's mouth. Do you think this is something more permanent in terms of an end to the war-driven volatility, or is it just another fragile yo-yoing rebound?
Yeah, I mean, look, ultimately, you're looking at a possibility of an outright recovery. People start talking about the idea of, oh, could we get back up to the previous record highs soon enough for, say, the S&P 500 and the like. That doesn't mean that this problem's going away. Remember, many people that know a lot more than myself have called the middle of April as the time where we're really going to see that crunch, because essentially many of these ships that already set sail from the Straits of Hormuz are only just arriving for many parts of the world. And once that final ship arrives, there's not any behind it. So suddenly you see a significant squeeze. Suddenly you start to see first order, second order effects taking hold. So really at the moment, it feels like everyone's just looking at what Donald Trump says and thinking, oh, if there's an agreement, then we just buy the dip and we're back up to record highs and we can forget about all of this. But there's a significant shock that is coming to the global economy, highlighted by the IMF, and it has a lag. And that lag means that for the time being, maybe people are becoming a little bit complacent about that risk.
I always thought in times of panic, people rush to the dollar as a safe haven. But if the peace talks that have been taking place don't deliver a definitive ceasefire, is there a risk for the US dollar?
Well, no, I think it's actually the opposite, quite frankly. The major benefactor of all of this has been the US dollar. And as soon as we started to move towards a potential resolution, the dollar has been hit hard. This comes because of the fact that we're seeing a shift away from sort of dovish rhetoric and more towards hawkish, where we could see a pause or rate hikes coming into fruition. But that stands for many of the central banks around the world. But certainly the US really is at the forefront of that. And that's why we have seen significant upward pressure for the dollar throughout this crisis. If we do see a resolution, and then, yeah, it's likely we're going to see that wider bearish theme coming into play in a more prominent manner.
Josh, that 20% jump in Samsung SDS shares that I mentioned a moment ago, does that mean the regional tech sector had just bottomed out and is now on the up, or is this just specifically good news for Samsung SDS?
I think it's a particular good news story for the company itself. It's a vote of confidence in them and their sort of pathway forward in terms of a top-to-bottom AI solution that they're looking to provide. Certainly, if you look at the wider theme, though, this comes at a time where we're seeing real significant strength for the AI names and for the big tech names. If you look at the strength for, say, US markets yesterday, it was essentially driven by Mag 7 names. So this news coming at the time where we're seeing people really buying the dip on those AI names means that it sort of accentuated the move. So yeah, strength for the wider theme, but of course that 20% move really is sort of knock-on implication of the deal that we've alluded to.
Josh, great to get the analysis. Thanks so much. Josh Mahony, Chief Analyst at Scope Markets.